Welcome to this week's Money Metals podcast, helping gold and silver investors during these treacherous times. Now, here's this week's market wrap with commentary and analysis from the company voted 2015's Precious Metals Dealer of the Year in the U.S., Money Metals Exchange.
Welcome to this week's Market Wrap podcast. I'm Mike Leeson. Coming up, Frank Holmes, CEO of U.S. Global Investors, joins me to share his thoughts on Trump's first 100 days, the resetting that's going on the global political front, and gives what he sees as a very realistic price target for gold before the end of the year. Be sure to stick around for a fantastic interview with Frank Holmes coming up after this week's market update. Precious metals markets are putting in a mixed performance this week as gold prices hold above their breakout level from the prior week. Spot gold currently comes in at $1,287 an ounce, essentially unchanged on the week. Silver, meanwhile, is faring worse on the charts. Last week's apparent breakout to slight new highs for the year in silver didn't bring any follow-through this week. Silver prices are down 3.3% since last Friday's close to trade at $17.97 an ounce, meaning the gold-to-silver ratio has widened this week to 71.6 to 1. Turning to the platinum group metals, both platinum and palladium rallied strongly on Thursday to erase losses posted earlier this week and are now both little changed since last Friday's close. Platinum currently trades at $981 per ounce, posting a small 0.3% gain on the week. Palladium comes in at $797 and is registering a weekly loss now of 0.4% as of this Friday morning recording. Well, millions of Americans breathed a sigh of relief after tax day came and went. Their filing obligations may be over until next year, but there is no reprieve from accumulating tax liabilities at the federal, state, and local level. According to the Tax Foundation, Americans will pay more than $5.1 trillion in taxes at all levels this year. That doesn't even include compliance costs. But actual taxes paid still amount to more than we will spend on food, clothing, and housing combined. Another way of calculating the tax burden governments impose on us is by looking at how many days in a 365-day year we have to work on average just to pay taxes. For 2017, Americans have to work from January 1st until April 23rd, 113 days, to reach Tax Freedom Day. If the future liabilities represented by current federal borrowing were included, then Tax Freedom Day wouldn't come until May 7th this year. The Trump administration wants to cut tax rates, but has no realistic plans to cut the deficits. In fact, Trump's Treasury Secretary, Steven Mnuchin, is demanding that Congress raise the debt ceiling even as he champions tax reforms. Here's some of what Mnuchin had to say before the Institute for International Finance earlier this week.
I'm confident we're going to get the debt ceiling raised. I'm hopeful that it's before the summer. I am focused on the debt ceiling. I think, as you know, I do have these special powers that I get to move money around and do special things. So even though we've hit the debt ceiling, we can continue to fund the government. By the way, we had a big day on April 18th. I would just say it took in tens of billions of dollars on tax day. We will get tax reform done. It'll be sweeping. It'll be significant, and it will create a lot of economic growth.
Stock market investors will take growth any way they can get it. They still seem willing to give the administration and Congress the benefit of the doubt on getting something done this year on Obamacare and tax cuts. But if nothing happens by this summer, the big hope now priced into stocks could turn into big disappointment. Even if Donald Trump does get his tax reforms through Congress, that won't necessarily be positive for the U.S. dollar. Deficit hawks fear the return of trillion-dollar deficits and new quantitative easing programs to paper over the growing shortfalls. Prudent investors are diversifying into physical precious metals and increasing their holdings as opportunities present. Buyers of all budgets will find a wide selection of bullion products at Money Metals Exchange. We are always looking to expand our inventories with new and interesting coins, rounds, and bars, and the occasional item that is in a unique category of its own. Gold jewelry normally wouldn't be something we would sell because it doesn't have the purity of bullion and carries hefty markups over most retail bullion products. However, we are pleased to announce that we now offer a 1-ounce pure gold bracelet. This form of wearable bullion is crafted from 1 troy ounce of 0.9999 fine or 24 karat gold with a beautiful hammered finish. The bracelets are manufactured with care here in the U.S. and stamped with its 0.9999 purity on the inside ring. They are shipped in a gift-style box with a certificate of authenticity. The classic and simple design is suitable for either a man or a woman. Give one of these bracelets as a gift, put one on your own wrist, or simply add them to your gold bullion holding. You can obtain these beautiful and stunning gold bracelets from Money Metals without the jewelry markups. Premiums range between just 7% and 9% over the melt value, meaning these bracelets are competitive with the premiums found on most 1-ounce gold bullion coins, such as the American Eagle. Since they look like ordinary jewelry, these bracelets are also a convenient vehicle for transporting significant amounts of wealth when traveling. A small amount of jewelry won't raise too many questions from suspicious TSA or customs agents who would more heavily scrutinize gold that is transported in the form of coins. To order gold bracelets or other product offerings from Money Metals, give us a call at 1-800-800-1865 or visit our website at moneymetals.com. Well, now, without further delay, let's get right to this week's exclusive interview. We are fortunate today to be joined again by Frank Holmes, CEO and Chief Investment Officer at U.S. Global Investors. Mr. Holmes has received various honors in recent months, including being named America's Best Fund Manager for 2016 by the Mining Journal, and received 2 more Lipper Awards just last month in both the 3-year and 5-year precious metals equity funds categories. He's also the co-author of the book The Gold Watcher, Demystifying Gold Investing, and is a regular guest on CNBC, Bloomberg, Fox Business, as well as right here on the Money Metals podcast. Frank, welcome back, and thanks for joining us again. How are you today?
I'm well, thank you.
Well, you mentioned back in January when we had you on right before Donald Trump's inauguration that the first 100 days of his presidency would be key on several fronts. So give us your thoughts on what these first 100 days have looked like. What have you gleaned from the last few months as you've been evaluating his policy decisions and the market's reaction to those?
Well, I think it's really difficult to grasp the difficulties of getting change in Washington. There's just so many people that are addicted, from lobbyists to whatever, on regulations and more rules and regulations for taxation for every agency that there is. And it's been much more difficult for him to tackle that than it was expected. And that's recently shown up with interest rates falling back below and giving a negative interest rates, gold rallying from that. And I think it's hard for the average investor because something like 70% of the media is biased and they're pro-Democrat no matter what it is. And so you find the narrative from even so many business columns are wanting Trump to fail. And I find that really saddening because a great investor, the greatest in the world, Warren Buffett, who bet on Hillary Clinton, and then when Trump won, he said, well, I'm behind the president, and if he does well, we all do well, so that's what I'm going to do. And I'm more of a Buffett cheerleader in the thought process. So I think it confuses a lot of people how difficult it is. And I think that to really read through his message that he wants bilateral agreements, he wants to renegotiate agreements to what's the benefit to the middle class of America, I think that that's very positive, but it's no matter what he does, we're just getting skewed with a negative sentiment.
Treasury yields jumped following Trump's election, but topped out in the middle of March and have begun to slide. There's a real question about what to expect in the months ahead. Janet Yellen and other officials at the Fed are talking about hiking the Fed funds rate. That talk could be putting upward pressure on yields, but it isn't, at least not in recent weeks. Now, that may be good news for metals. You recently wrote an article about gold as the beneficiary of negative real interest rates, and we talk a lot about that with you because we both believe that is really the factor that drives the gold price. If you would explain the concept of negative real interest rates and why they would be good for gold prices, and then talk about how much longer you expect the negative rate environment to persist.
Governments basically have 2 levers to manage the economy. One is monetary policy, the other is fiscal policy. Monetary policy is money supply and real interest rates. And fiscal policy is tax and spend And regulations is a indirect taxation on a sector of the economy. When it comes back, what we witnessed under Obama was an administration that was on steroids in every department on new regulations, just a massive increase. And the only way to have economic growth with this massive increase in regulations, which has always been a drag on an economy, is to have cheap money, low interest rates, and to a point where they went negative. And why do I say negative is that every month we get what's called the CPI number. And the CPI tells us what the Consumer Producer Index of inflation is. And that inflation index is an important factor because if it's 2% and the government wants you to buy their 10-year government bonds and they're only going to pay you 1.5%, you'll say, well, that's a bad deal. I'm going to lose 0.5% every year for 10 years. So whenever that happens, gold becomes a very attractive asset class, and so do companies that are paying dividends and that have the capacity to raise dividends. That's the other part where you've seen the stock market rally for the past 8 years predominantly, and we've had negative interest rates. And you've seen gold fall and rise every time we've had this positive negative. So for your listeners, every month CPI number comes out, and you deduct that from whatever the government wants you to pay for their 5-year and 10-year government money. And the correlation is immense. Anytime they're paying you more than the CPI number, gold falls. Anytime they're paying you less, gold rises.
Yeah, very well put. It is obviously a big thing that we look at and we'll need to continue to look at. What are you expecting for that situation here going forward? Do you expect a negative real interest rate environment to persist here, Frank?
Yeah, I think that as long as you have this massive burden of regulations, you're going to have cheap money. And raising interest rates right now is only going to hurt the economy. And there's some parts that are already trying to show up with that. The concern is stay away from auto parts. Automakers, there's a huge inventory that a lot of the recent cars have been financed with basically junk paper because a lot of people can't qualify. It seems to be a very risky sector. And so what happens if that short-term interest rates now, I remember I went and called and asked some car dealers locally, and if you want to use their services, it's 4% for a car. If you can get one of the credit unions here, you can get it down to 2%. But a year ago, it was 1.25%.
Switching gears here a little bit, Europe is likely to be even more prominent in the headlines in the next 3 months. The first round of the French presidential election will be held Sunday, and Theresa May just announced snap elections in the UK to be held in June. And in some sense, the poll results will be a new gauge on the popularity of Brexit. The Prime Minister expects to solidify support for getting on with the departure from the EU. You just returned from a trip to Switzerland where you spoke at the European Gold Forum. What did you hear there from Europeans, and what are you expecting from events there? Will the EU be able to ride out this turbulence, or is there still more big trouble to come?
I was in London also and had a lovely lunch with Nicholas Vardy. Very insightful. He was a newsletter writer that went to Stanford and then did his law degree at Harvard and was there with when President Obama was there and our new Supreme Court judge. So he's very insightful and talkative and gave me lots of color. And I know whenever I travel those places, I always ask the taxi cab drivers, what do they think? The thoughts of Brexit, it was ubiquitous. Everyone was happy for Brexit to go through, and they felt that the unions have taken control of the government policies in Spain and Italy and France, have prevented young people from getting jobs, and the only place for opportunity is in the UK. And they can handle only 50,000 families a year, and there's 500,000 coming in a year. So they feel that you can't stop these sort of socialist, unelected officials, and they'd rather control their own destiny. So I think the Brexit is an interesting event, and I think that probably the vote will still remain very strong, even though most of the media don't want it to see happen. But I think it will. I saw when I was in Zurich. The construction was booming. There's lots of reservations on the regulatory world globally. They believe that globalization, the slowdown of that whole took place 10 years ago with the difficulty of moving money, the proof of burden that your money is your money, and the paperwork that goes with it, that they will not open an account for any American taxpayer today. Neither will Bermuda, I found out. So you get this sort of different idea that the ability to move freely with yourself or money around the world is becoming restricted. But more so, the advent has been before building a wall between America and Mexico. All that drama that's taking place is actually really showing up in the movement of capital. It's much more difficult. And there are the things I learned. They're big believers in the gold. They believe that this mismanagement of fiscal monetary policy, the French government, the socialists there was proposing 100% income tax, basically taking people back to feudalism. Bizarre that he would think that. And I think what happens is that when you don't get mainstream thinking, that is, we want to have streamlined regulations, have taxes that are appropriate and accountable for what we're spending the money for. Whenever you get this excessive right wing or excessive left wing, you create volatility for investors. And that's something that's coming out of France. And France is the second most important part of the EU when England's gone. The other thing you realize is that England was the second biggest contributor to the EU budget, and that was sort of offending a lot of the British taxpayers that not only were all these immigrants coming in because of the bad government policies of other countries, they were sending their tax dollars out to build better places for France and Spain and other countries. So I think that the world is resetting. I think that's positive, get a rebalance there. And I think that we're going to continue to live with low interest rates and suffer with these regulations until we get finally a breakthrough. And once we get a breakthrough, because whenever you get fiscal policy incentives, which are streamline regulations, create tax incentives, you get a much bigger bang for your dollar and growth in the economy. That's why when China started its revolution with Deng Xiaoping in 1978, they created 7 tax-free zones. You see that in San Antonio to get Toyota to build a car plant here a decade ago was to provide all these tax and training concessions, and it's been a big windfall to us. So it is so key, and right now we're Washington's stalemate of streamlining regulations.
Do you expect the bullishness for gold that you were seeing there in Europe to make its way here to the U.S.? I mean, since gold is really the anti-dollar, it seems that we need U.S. hedge funds and some hot money to come into the market in the Western world to really take it to the next level. Do you see that happening here, Frank? And what could possibly trigger the renewed appetite for precious metals among U.S. investors? Because retail demand is quite soft, and it seems like most of the rest of the world are really the ones that are focusing on gold right now.
I think it's not so much this conspiracy theory on gold and money and dollar. I think it's better to look at the imbalances that take place in an economy's fiscal monetary strategies. And whenever you get these imbalances, gold will perform exceptionally well during that process. And it's in America and it's in many other countries in the world of this monetary driving the equation and not fiscal policy that's driving the equation, except for more taxation and regulation. So I just think that the U.S. is still at this imbalance. Europe is clearly a much greater imbalance and difficulty in this sort of monetary fiscal policy imbalance. And I think we're going to muddle along with it. You saw India has a surtax on gold imports, and finally, after all the currency debauchery that took place, where they wiped out 86% of paper money. See, 86% of Indian money, paper money, was in tens and $5 bills. 86%. And they said, if you can't show where you got that money from, then you lose 30% of the dollar value. You better run to the bank and show where that cash came from to stop the corruption as they're going through an election cycle. Well, that's all done, and immediately saw a surge in gold prices. The demand out of India is getting back to, it was up 300% from a year ago. So I think there's other positive parts to take a look at that gold demand. And the supply from around the world is just not growing the way paper money is growing, and there will just be these continuously imbalances. and you should have your exposure to gold, and it should be 5 to 10%. And the magic is to rebalance. So when we get these incredible runs, you have to take some profits off the table because we will get these big corrections, in particular in the stock prices. I think the real shocker here in this first quarter is last year in the first quarter when gold jumped 6%, you had a massive move of sometimes from 40 to 80% in gold stocks. This year, it's a very modest increase of like 14%, I think, for the first quarter, and gold was up 6.5%. And a big part of that is this GDXJ rebalancing, and it's almost 10% of all gold equity funds. Money's not really going into the gold equity funds, they're going into the gold ETF, which has no thought process on picking stocks for values, it's just market cap. And now they're making a decision that they don't want to have as much small cap because they could own too much of a company, and they've been dumping, and it's going to happen now for the next month, something like $3 billion worth the junior gold producers. These are disruptive in the capital markets. They make people skeptical, etc. But you know what? They provide an opportunity. If you can understand an index that's doing this and all the regulations around that index, and that's what they say as the reason they have to do this, then it becomes your opportunity.
Obviously, geopolitics are starting to flare up here as tensions between us, Syria, Russia, North Korea, and China are making headlines. Where does this all head, and what investment class do you see being the primary beneficiary of all this global tension? Because it does feel like we're in maybe the calm before the storm here, especially when you throw in everything that's going to happen in Europe with those key votes in the EU later this year. What are your thoughts there, Frank?
I think that dividend-paying stocks and have the capacity to raise dividends are going to still do well. I really do. I think that gold is going to be, there's so many great quality gold stocks that I think that they're going to do well. I think that MLPs that are involved in the shipping of energy, not the processing of energy, they're going to still do extremely well. You know, I'm constructively bullish. It's just that I think we're going to have more volatility, and volatility should be your benefit. You should understand what that DNA of volatility, and let me help you with your listeners. When you do a rolling 12-month period for the past decade, it is a non-event that is 70% of the time gold can go plus or minus 20%. And that's the same thing with the S&P. They're both the same. They both have the same DNA of volatility. But gold stocks have a DNA of volatility which is 2 times that. That is 70% of the time it's a non-event for them. They go plus or minus 40%, and so is biotechnology, and so are other sectors of the economy that have a greater volatility to them. So the magic is to understand that DNA of volatility, and every time you get a big sell-off on the gold stocks, you want to be a buyer because the math is in your favor to rebound back to the mean. And the same thing is with other asset classes like technology, or especially biotechnology, which has the same DNA volatility as gold stocks. Emerging markets have the same volatility of gold stocks. And that's another classic for your listeners. If you read, New York Times always has negative news on emerging markets, and Trump is bad because emerging markets, etc. Did you know that the Chindia ETF, which is basically China and India equally weighted ADRs, big cap stocks in that particular ETF, which represents 40% of the world's population, was up 2 times what the S&P was last year, and in the first quarter of 2017, its return was twice the S&P 500. So emerging markets are actually doing well. When I look at our emerging European fund, the dividend yields on there are averaging like 4%. When I look at our global resource fund, the dividend yields there are like 3%. I'm buying a real resource. I'm getting a dividend that's growing. It's growing at 3%. There's still lots of M&A activity in the chemical industry. So there's lots of places I'm constructively bullish on. If you believe of this other part is the whole theme on military spending is $600 billion. They've sold off here recently, but I think stocks like Boeing, which is in our JETS ETF, is not only making all the airlines that you're flying, but they also make a lot of components that's for the military. That stock has been a beautiful climb. We look at the budget's going to go towards military spending and technology towards that's the element of technology in defense spending. Those stocks, I think, are going to do exceptionally well over the next 5 years.
Well, gold and silver are off to a good start in 2017. We've talked earlier about negative real rates supporting prices and some other potential market movers that could drive demand for the yellow metal specifically. As we begin to close here, what else, if anything, are you focusing on in terms of potential catalysts that may drive things for the rest of the year? And do you think there's still some more upside in the metals?
Yeah, I think you're going to see. I was asked the forecast what I thought the price of gold could do, and I said, it could run to 1,500 this year. You had that probability on a rolling 12-month period. When I look at my quant models and I look at the fundamental factors around the world, it could easily do that. I also like to point out to all your listeners that every president in the 90s, and we've seen in the past decade, starts off with a campaign that China's a currency manipulator until they get into power and they realize they're really not manipulating the currency. The New York Times is anti-China, they're anti-gold, and they're anti-the Clintons. So it seems to be this pervasive, don't get confused with all those headline news, and recognize that China is, there's a lot more common with China's leader, with Trump, than you would normally think. And the same thing is with the leader of India, Modi. These are three mavericks that the media like to attack. They do things their own way. They go after corruption. They want to renegotiate deals. They all believe big in their own country. They're very country-centric. They want to trade with the rest of the world, but their priority is to be focused on their own domestic economy first. So I think this is really positive dynamics. And I'm going to bet, like Buffett, I'm being positive.
Well, thanks for the fantastic insights as usual, Frank. It's always great to hear your thoughts, and we really appreciate your time once again. Now, before we let you go, please tell our listeners a little bit more about your firm and your services, and then also about your fantastic Frank Talk blog.
Well, thank you. Very kind, gentle words. I love it, and we do work very hard. We've won 88 awards in a competitive arena in the fund business on education. So we have 40,000 readers in 180 countries, and I welcome to go to usfunds.com and sign up for Frank Talk. I talk about my travels around the world as we start off this conversation and try to relate to investors my tacit knowledge along with my quant explicit models to try to navigate through the world. So please go to usfunds.com. We have the top-performing gold funds. We have also, I love the short-term tax-free fund called NearX. It's stable, $2 approximate price, and it's much better than a money fund because of its higher coupon, much higher. And so we have many different types of funds from China to Eastern Europe and domestic funds.
Well, excellent stuff. Thanks again, Frank. Congratulations on picking up some more awards. Very well deserved. Keep up the good work, and we'll look forward to speaking with you again in the coming months. Take care.
Well, thank you once again, my friend. Cheers.
Well, that will do it for this week. Thanks again to Frank Holmes, CEO of U.S. Global Investors. The site is usfunds.com, and be sure to check that out. And also the previously mentioned Frank Talk blog, some of the best market commentary you will find anywhere on gold, the miners, the commodities as a whole, and many other topics related to the investment world. Again, you'll find all that at usfunds.com. And check back here next Friday for our next weekly Market Wrap podcast. Until then, this has been Mike Gleason with Money Metals Exchange. Thanks for listening, and have a great weekend, everybody.
Thank you for joining us for this week's Money Metals podcast. Be sure to come back next week. And don't forget to subscribe to our podcast through iTunes for answers to all of your questions, or to discreetly and securely buy or sell gold or silver coins, bars, and rounds. Call 1-800-800-1865. or visit www.moneymetals.com. Our knowledgeable and no-pressure specialists are standing by between 7 a.m. and 5:30 p.m. Mountain Time, Monday through Friday. Or you can lock in your order online, 24 hours a day, 7 days a week. Again, visit us at www.moneymetals.com or call 1-800-800-1865.